All right. Well, welcome back to Taipei, Tom Lee of Fundstrat. We were together for most of the day yesterday, welcoming Governor Shirakawa of the Bank of Japan to Taiwan. His talk highlighted two important points, which number one were the kind of exhaustion of traditional monetary policy as we know it, with interest rates either being very close to zero or even negative. But number two, the importance of demographics in driving economic growth. That dovetails very well with your long-term thesis, Tom. So maybe you can tell us about global demographics, who stands to benefit, who stands to perhaps suffer from that.
Yes, I mean, I'd say demographics is actually one of the least appreciated by most investment, theorists, strategists, economists, because I think they tend to think it's quite boring. Who cares about births and deaths and things that take 50 years to happen? And but at Fundstrat, we've spent quite a lot of time focusing on demographics because I think it really explains a lot of actual history. And Shirakawa-san, made these points. Number one, if you went 20 years ago and looked at the 7 major economic regions, Europe, Japan, China, US, Russia, etc., and you use the UN's projections for 20-year population growth rate, only 2 countries had positive projected population growth from 1999 to today, in the next 20-year period. It was US and China. And every other country was either stagnant or shrinking. 20 years later, which 2 countries have captured all the economic value over the last 20 years? It's the 2 countries that grew. So population's clearly a huge deal, and I think Shirakawa-san really made that clear. That Japan's case, QE and zero interest rate policy was quite successful because on a per capita basis they were able to actually grow the economy. But the fact is, Japan's population has shrunk, so you can't fight that tide of shrinking population.
Great, and that's a nice segue into the topic of U.S.-China, how should I say, tensions in the trade arena over the last 2 years. Where do you score things right now, and then your prognosis going back to the demographics in the next 10 years?
Yeah. So U.S. and China, they're the 2 most important economies in the world. They're also the 2 wealthiest. There's $300 trillion of household wealth in the world. U.S. controls 100 trillion, China controls 50. 2 countries control 50% of all wealth. And by the way, the majority of that wealth was accumulated by a 20-year band of individuals. So the boomers basically own all of the wealth in America. And I'm largely overstating that. And then China, a single generation owns, the $50 trillion of wealth. And people kind of think, they're kind of shocked because they'll think, hey, what about the Middle East? Don't they have a lot of household wealth? Saudi Arabia is the richest country in the Middle East. Household net worth is only $1 trillion. China has 50 times the money. So 2 countries have proven they can grow their population, and 2 countries have proven they're really good at reinvesting that wealth to capture value for the household sector. And that's kind of why the US and China, whatever happens here, it really has implications for everybody. Those are the only 2 economies that have demand, the only 2 economies that have, value capture industries, and so I can see why it's a big deal. If I was to give you our demographic take, China was really the king over the last 20 years because they had a massive, massive surge in available workers. Part of it was that rural to urban migration, and part of it was purely demographics. They had a birth boom that started to really become prime age workers in the last 20 years. In the next 20 years, China no longer has worker surplus. We have a lot of charts to show that the U.S. is actually seeing a millennial uptick. China is actually contracting pretty rapidly because of their one-child policy. And at the same time, the world doesn't have worker surplus. So the next 20 years is about countries that can supply automation. Only 4 countries can supply automation: U.S., China, Japan, and Germany. So those are going to be the 4 countries that really battle it out to become the global supplier of labor.
So mapping that back to Bitcoin, how does that demographic trend match up with Bitcoin and the fundamental outlook for Bitcoin?
Yeah, it's a good question. I mean, I think Bitcoin, in our minds, is very much a demographic story. But that demographic story is not only about the preference of youth, but it's also how each generation generates economic growth. So let's start with that second point. Every 20-year interval that anyone could look at, and if you say how much of that growth was native digital. So in the, let's just start back 1950 to 1970. Very small, because that was an industrial expansion, and it was all about building infrastructure. And the 70s to 90s, there was semiconductors and computers. So about 10% of global growth was generated by pure digital services, including financial services. In the last 20 years, that number is close to 50%. So if you defined by the important industries that grew, tech, healthcare, financial services, and apportioned how much was pure digital value capture, about half of all global growth in the last 20 years was digital. In the next 20-year interval, it's probably going to be 75%. Do we need regionally defined fiat currencies if 3/4 of economic growth is driven by purely digital services? I think it makes sense that in this generation, the next 20 years, it's going to be digital services settled with digital money. But more importantly, young people are a digital generation. There are people growing up that never see paper currency, and so to them, they want something that's frictionless, trustless. Clearly millennials don't like banks because of the financial crisis. And so what's the alternative to a banking system? It's going to really be, some sort of, I'm not going to use blockchain, but let's just say some sort of decentralized, trustless value capture system that doesn't let centralized entities make all the money.
They don't like banks, and they don't like capital markets either. Like if you look at equity participation within, pretty much any developed market, whether it's, even Taiwan or the US, that 18 kind of below kind of 25-ish cohort, their participation level is really low.
Yes.
So I think if part of the demographic argument, I think also is the great wealth transfer that happens from boomers to mostly to Gen X, and then a little bit to millennials, and then where do they spend that money?
Yeah, I mean that's a great point. I mean that $100 trillion is with the boomers mainly, and but their average age is 62, so they're going to live for quite a long time. But there's 4 million by year, per age interval, and there is going to start to be mortality. And that money gets transferred. First Data estimates $7 trillion will be inherited by millennials in the next 5 years.
Yeah.
So 7% of the total.
And if a boomer came into that money, they would buy a house, right? So another thing that millennials don't seem to like is house ownership. So it's kind of interesting to speculate where that asset, where those resources could be allocated.
Yeah. I mean, yes. In America, I don't know what the millennials will do with their money. Yeah. At Fundstrat, we've been doing a lot of work. We actually think there's a massive housing boom coming because of this. Remember, the biggest impediment to a millennial to buying a house actually isn't that they don't like homes. It's they don't have the down payment.
Yeah.
So, and in America, if you're a first-time home buyer, you only need to put 5% down.
Yeah.
So to buy a $100,000 house, you need $5,000.
So I think if you ask most people, they probably think that global housing prices are at elevated levels. And I wonder if that is skewed by so I'm from Canada, so Vancouver, Toronto, a lot of those kind of, maybe these urban centers have historically high valuations, but I wonder, is that just a problem of averages? Like if you look at a median level, certainly there's areas in the US where it'll be a lot different. Is that kind of what you're thinking? Or?
I mean, if you do aggregate home value to GDP in the US, so that's apples to apples, right? You take the level of housing stock in the US times median home sale price to value total inventory homes, and you can then create a series from 1930 to now. So you have 80, or actually close to 90 years of price history. Mm-hmm. Home price to GDP is like where it was in the 70s. Ask anyone in 1970, which is the boomers, were probably in their 20s then. Nobody probably thought housing was interesting to own. Remember, that's a $13,000 townhouse in New York City that's worth like $5 million now. So housing in America is not high-end, not Greenwich and not, Silicon Valley, but like the average home in America is incredibly cheap.
So how does wealth inequality play in with that? Because if you look at GDP, a lot of that is, probably held in a smaller number of hands. So, how many houses do the ultra wealthy need? So yeah, does wealth inequality impact that thesis at all?
I think you're making an inference, like a presumption that housing ownership is skewed to rich people. It's not. 60% of Americans own a house. So housing is probably one of the most widely owned asset classes. Equities is the tiniest. If you look at Gallup polls, equity ownership by household is at the lowest since the 70s. So the one thing that people seem to not like, and you mentioned it earlier, is equities. But housing, I think people want. In fact, there's this thing millennials call hiptopia. No, hipturbia. Have you heard this phrase? So millennials are moving to smaller sized towns near a city, buying a single family home with a yard.
Got it.
Oh, it's not suburbia, it's hipturbia.
It's hipturbia.
Well, it sounds like a suburb, but it's called hiptopia.
It's a cool suburb.
Returning to the digitalization, fully agreed that, especially with millennials, most, if not, 90% of their lives is probably digital. But does that presume a truly borderless world? From the looks of it, there may be more than one 5G standard. It may be that Android isn't fully used around the world. There'll be subversions of it. And then as it pertains to digital currencies, we have perhaps two competing visions from a certain US-based social media platform and a sovereign entity in this part of the world. How does that look? I agree that borders will become blurred, but will they disappear completely?
Yeah. So Alex, I think you're bringing up two kind of interesting things. One is, geographic. Do geographic boundaries make a difference in the future? In the past, if you were from a northern state or a southern state in America, you were different. But today, everyone's the same. Like teenagers are all the same. But the second point you're making is, is in that borderless world, is it winner take all? There's a concept that the DOJ, Department of Justice, uses called the Herfindahl Index. I don't know if you're familiar. It's a measure of concentration. So the Department of Justice uses this concept, which is a measure of market concentration. They call it the Herfindahl Index. Herfindahl-Herschel Index, HHI. And the idea is you take the number of players, so if you have a 100-player market, you take the number one player, its market share, times the second player times its market share. So what you get is what they call a HHI score. Okay. And concentrated industries are considered bad.
This is for an antitrust consideration?
Yes.
Okay.
And I think if you could actually, because Herfindahl Index used to be published for every industry in America, you could actually see the level of concentration over time. So most people think that only one or two players can succeed. And that's been, that's a monopoly, or duopoly. But that in tech has actually been what's played out, right? So what we've seen is monopoly platforms created, whether it's social media or, search or, those businesses today are monopolies. In the next 20 years, I don't think more industries will be that concentrated. So I think it's more likely that we have splintered village money than a single currency, and I think it's less likely that we have single strong entities. It's going to be splintered entities.
Tom, I can see it both ways. One, we had this Cambrian explosion of coins over the last 2 to 3 years. I think we've seen in the last 6 months a consolidation. So the village money concept theoretically would be represented in this explosion, but this mass extinction, if you will, has subsequently followed. I'm trying to play out the case where if I have a duopoly in this world, perhaps centered on the US and China, if I were some Polynesian islander, or if I were living in Venezuela and I had internet access, why would I prefer my own village money?
Yeah. So Alex, now we're talking the future, so whatever you say and I say, doesn't matter. Generally, I don't like to weigh in with my opinion because my opinion doesn't matter, but I'll just share some observations. One is, when it comes to banking and finance, it's actually an incredibly splintered and fractured market. For instance, there's no single big bank. There's central banks, but not for-profit banks. There's no single major broker-dealer. There's no single major regional bank. I mean, in America, I think there's 21,000 banks, and they all make money. You know what I mean? Like, you have it's really the minimum scale. So I think if a single currency creates the best and most efficient way to move money and it meets people's social preferences, then I can see that happening. But
I don't see those two as being in conflict. I mean, the fact that there are 21,000 banks in the United States, they use the same basis of accounting, or unit of account rather, and you do need your local lender. You do need a community.
Do you know how much inefficiency has resulted in that?
I don't know that.
Just to give you an idea, so 20 years ago, U.S. banks, or collectively, financial services was, I think, 3% of GDP. This is 50 years ago. This is OECD data. Today it's 6%.
Yeah.
So the cost of banking has doubled in America at a time when interest rates went from 16% to zero.
Yeah.
And technology makes banking frictionless. There are online banks that have massive valuations and good margins and make better ROEs than regular banks. Yet these regular banks make plenty of money to keep the lights on, and they've doubled their share of GDP. So there's something that these banks are doing that people are willing to pay a lot more to use.
Sure.
That's the reality. So, but listen, when it comes, I don't have a time machine, so I can't, I don't know the future.
I want to kind of converge on this point of optimism. I mean, you identified December 2018 as a singularly bad month because of Fed moves and basically the market reacting in a nonsensical way, but you probably were in the minority when you saw a bull run in the S&P in 2019, and indeed it's gone up over 20%. This is in an overall, if you just read the news or watch the talk shows, in a bearish kind of expectation, and you expect this party to continue into 2020. You share a similarly sanguine outlook for many digital assets, Bitcoin being prominent among them. This is somewhat in contrast to some views as to these two being, Bitcoin being a hedge or a risk-off asset, and if things go wrong in other markets, you kind of vacate into this. But you actually think they can all do well at the same time. Can you explain that?
Yeah, got it. So it's a couple parts, I guess, Alex. One is, yes, I think that the consensus view, so consensus mean, the broadly held view by the media and institutional investors is that the global economy is late cycle and about to tip into a recession. Now, if that consensus view was correct, there's zero chance stocks go up. Stocks can't go up if the economy is contracting, right? So, our implicit belief that we're bullish, and we said at the start of this year, we said 2009 was the best analogy for this year. We thought this year would look like 2009, and in fact, it's really been a textbook 2009-like year. It's because we think the industrial cycle is turning up. So I think that the trade war and all this had caused the entire machinery to slow down, and now that inventory correction is over, and so the machinery is starting to crank up again, and I think we're actually about to have a pretty big risk-on boom. Now, for a lot of people in crypto, this is not something they're happy about, right? Because I think a lot of people are unhappy with the financial system. They kind of want it to sputter, and they want this alternative system, which is blockchain and crypto and digital assets, to boom. We've been sharing an unpopular opinion this year that Bitcoin actually is a risk-on asset, and crypto is a risk-on asset. So in our sort of framework, the stock market needs to break out of a range, and then it sets the stage for a massive breakout for crypto. And I think the reason we have that view is, it's kind of simple, and is I think the market where it is today, it's freakishly small. I mean, I think people are overestimating how many people own crypto. We think less than 500,000 people actually use it every day, like in an active way. And the incremental buyer, therefore, is a retail investor. That retail investor isn't betting on calamity. They're buying stocks and they're buying crypto because they both think prices go up. So that's kind of our thesis. And we can show that like in the last 10 years, the best years for Bitcoin have occurred when S&P's been up more than 15%. So they've been correlated.
Yeah, I think the seasonality of Bitcoin kind of matches over onto your equity view too, right? Because if you look at the seasonality over the last 5 years, it's like October, November, December are the strongest months typically for Bitcoin. So I guess that kind of matches up with seasonality in equities.
Yeah,
right?
the best 6 months in stocks are October to May.
Yeah. So one question on your equity view, is there a decoupling then between the economy and markets? So if markets are up here and the economy is thought to be, your view is that we're in a cyclical, we're hitting the bottom. Has it decoupled? And then is that priced in already?
Yeah, look, listen, I think a lot of people are bearish. Okay, so first of all, the reason people are bearish is that they can be bearish for several reasons. One, the economy's done well for a long time. So it's like, hey, we're due for a recession. I mean, I understand that. The second is I think a lot of people don't like the current White House and they want it to fail. And the best barometer of, especially in 2020, the single biggest pivot arguably for 2020 re-election of the Republican president that we have is the stock market crashing. So every Democrat in the country and everybody who doesn't like the president
is rooting for that.
Yeah, so we call it recession mania. We have 11 constituents that if you add it up, it's the majority, like over 70% of America and over 50% of the world wants the stock market to crash. Because remember, people who are long bonds have been a monster trade this year. The Austrian, you guys have seen the numbers. German 60-year bonds up like 60%, Austrian 100-year bonds up 80%, the US 30-year bonds up almost 40%.
100-year bonds.
Yeah, long duration. If you're long duration, you want calamity. So bondholders want their world to crash. Basically, the only people that want the market to go up are those who are hardcore Republicans that are, voting for the president, or equity bulls. It's a very small percentage of the world. And so I think that's contributed to the bearishness out there. But yes, listen, if the economy is stuck, there's no way stocks go up. But, the one thing people have to remember, and I think everybody who survived equity markets have learned, and I've done markets for over 27 years, you can't tell the stock market what to do. You have to understand what the market's telling you to see where everyone's framework is wrong. The stock market is not a dumb voting machine. Semis started rallying in May of this year. The German stock index, the DAX, started rallying in August. Okay, the DAX is the deepest cyclical index in Europe. It's all smokestacks. Industrials in the US started rallying in October. These three industries cannot rally if we're about to tip into recession. And look at the charts, they're massive, massive rallies.
So you're saying it's inventory being worked off. The demand is still there.
Yeah. And everybody else thinks they can tell the economy what to do. They can't.
It's true. I'll take one small example. I mean, the latest iteration of the iPhone, nothing new really, and maybe another camera lens, but it's selling extraordinarily well, actually beyond expectations. So I agree. Probably the underlying demand is probably stronger than we think.
So is that just for the US or is that globally? Like the EU certainly looks a lot weaker, right?
I'm going to go back to a point that has navigated as well for the last 10 years. Only two countries matter, China and US. Everybody else doesn't matter. Forget what Europe's doing. It doesn't matter. Here's a fact. If you look at the US, Europe, and Japan since World War II, for every US recession, Europe's had 2 and Japan's had 3. The US economy and China are the independent variables, and every other country is just beta to what's happening.
Just noise.
So to your point, Alex, it's iPhone and housing that drive the economy.
Fair enough.
So what about the 10-year experiment that we're into with the whole quantitative easing thing and record debt levels in the US? How does this, is that a problem? Are these debt levels a problem at all? How does this rectify itself? Because I think this is something that gold bugs and Bitcoin people are specifically paying attention to.
Again, I think people say facts without actually really thinking about it. Look, debt, when is debt a problem? Debt's really a problem when it crowds out something else. And it can crowd something out because either you borrowed so much money that no one's going to lend to you, so you have liquidity, or your debt service is so high that you're kind of screwed. That's France 1760, Louis the 16th, right? French Revolution. Debt level in America, how are people saying there's so much debt? First, debt to GDP for the US federal government is lower today than it was in 1950. So the US was more indebted after World War II and Korean War by almost 40% more than it is today. What you have to look at is debt service. The Fed had pinned interest rates in the 40s and 50s at 1.7 in order to let the US borrow money. And from 1950 to 1969, interest rates went from 2% to 8%. In America, the 10-year, it quadrupled. I would like you guys to guess what you think happened to the stock market and what happened to the federal deficit in that 20-year period. So 2% to 8%. Quadrupling our rates.
My guess
is this single best 20-year period for stock market returns in history. That was the best annualized return for equities. Federal debt to GDP went from 86% to 20. That's debt to GDP. And federal debt service stayed at 2%. When interest rates go up because inflation picks up, borrowers benefit. Remember, debtors want inflation. The only thing that's killing the world economy today is there's no inflation.
See, that's an interesting one. So we keep getting told that there's no inflation, but I think to people on the street, it feels like there's inflation, right? Like houses are expensive, gasoline is more expensive, your kids' tuition goes up 5% every year. Like to people on the street, it feels like there's inflation, but we constantly are being told that there's no inflation. So how do you match those two up?
I don't think there's inflation. You know there's no inflation because inflation expectations are zero. You look at all the surveys. No one really expects inflation.
If you look at the
I know the CPI shows very little to no inflation, but just I think what Jesse is saying, it matches my intuition. I remember distinctly during the summer of 2007 when gas in the States went beyond $4 a gallon for the first time. And that was front page news.
Yeah.
Here we are a little more than a decade later. It's pretty close to $4, if not over. Nobody talks about it because it's just kind of acclimated. So
just keep in mind there's 131 items in the CPI bucket.
So
131.
Right.
You should take your list every year, what's increased, and look at what's decreased. That's why there's no inflation. Unless there's a continuous coordinated rise in prices that change expectations, there's no inflation.
You're saying because our computers or electronics have gotten cheaper?
Well, that's a generally accepted theory. You know what? I don't know. I'll just tell you the reality is goods are produced by people. So labor, wage cost is your single biggest new driver of inflation. People think it's food prices.
Yeah.
It's wrong. You take a box of cereal in America, this is just a fact. It's $4, right, to buy a box of cereal. And corn is the biggest food input into that box of cereal. Out of the $4 box, how much do you think corn is in that cost of that $4 box of cereal?
50 cents.
That's a good guess. What do you think it is?
I don't eat cereal.
Well, I know, but just a guess.
I have no idea.
Judging by the farmers in the Midwest, they're...
So all of the food in a box of cereal is about 12 cents worth of food.
No shit.
That doesn't surprise me.
So remember, corn is $6 a bushel. You know what a bushel is?
Yeah.
You and I can't even lift a bushel of corn.
Well, that's why they're making ethanol out of it.
Yeah. So corn, when you buy cereal, you're buying marketing, packaging, paper product, transportation. You're not paying
shelf space, basically.
Food is not expensive.
But the increase in the money supply, like if you're kind of a more Austrian kind of guy, you see the massive increase in whatever the metric is, M1 or M3. It's a chart like this. So how can money supply increase so much and there be no impact on inflation?
I don't know. Again, like I'll just say, I'm just going to use a common sense measure of inflation.
Yeah.
Wages are the biggest input cost to things. There isn't wage inflation. If there's not wage inflation, you don't have inflation.
All right. So, Tom, you just came over from San Francisco Blockchain Week. Anything new that you saw? I know you're keeping an eye on Hashgraph, on Zilliqa, on a few other projects. Anything noteworthy?
Yeah, I mean, I would say, San Francisco Blockchain Week's great event, high quality people. And the two things I would say I noticed is one, we're kind of closing it out of 2019, and things are slow. I mean, there isn't like some boom happening here, in crypto. But it's not because there isn't a lot of good ideas. There's a lot of good ideas. I just think there's been a real increase in regulatory risk in America. That's made it hard to raise money. But the second thing that I would say that really struck me, and I think people would all agree, is that the exchange, the landscape evolved. I mean, look at the exchange business. Just compared to 12 months ago, and who are the winners and losers? It's almost like someone just took the chart and then turned it upside down. So people like a year ago in America, who were the top exchanges with big share? Those guys all shrank. And there's a lot of new people who've done quite well. I mean, I think the landscape has moved really rapidly, even though there hasn't been a lot of growth.
So I think that's a really interesting question too. Like, this is something I've asked myself: is how does the exchange landscape evolve? Like, so we've got backed in now, we've got Fidelity doing trading and custody. Do the incumbent players eventually come in and take over this industry, or is there a place for Coinbases and Geminis, and then other exchanges like ourselves offshore?
I mean, there's some guys still doing it right. I mean, Binance is kicking butt.
Yeah.
OK is actually doing pretty well. OKX, and BitMEX is still cranking and is still a go-to place, even if its share has fallen. And what have they shown? I guess they've shown that in the exchange business today, it's not trading cost and it's not price. It's either the ability to get enhanced returns through futures, or it's liquidity, like real deep liquidity, or it's great social marketing. I mean, I think Binance is just doing so many things right. And, does that mean when the big traditional exchanges come in, they're going to win? I don't know. I mean, I'd say some of these existing exchanges are doing a good job, and they're going to stand on their own pretty well. But, there's others who are in crypto today that you've seen their volume shrink. They're not as differentiated. These big exchanges come in with customers, regulatory relationships, a whole bevy of services that extend way beyond what traditional exchanges do. Those are the ones that have to rethink their business models.
Yeah, and regulation is a huge part of that. Like, previously I was at a bank and we were looking at, what exchanges could we interact with? The first question is regulated, yes or no. And if it's no, then there's no more, we don't do the other questions, right? So that's such an important issue for mainstream institutional investors, is the degree of regulation.
Could you zero in on regulatory risk? I mean, I agree that it's kind of taken on a much higher profile, especially in the US, but what does that mean for these players that you just discussed?
Well, regulatory risk is something that I don't think people in new industries necessarily appreciate, because look, if you're creating something new, you just move fast and break things, and I covered wireless for a long time.
Yeah.
And wireless was competing in the telecommunications industry, which is massively regulated. I mean, outside of financial services, utilities and telecom are the second most regulated because they service everybody, so public good is a huge deal. And in crypto, I think people have been really fixated on what the SEC would do. Like, hey, is Bitcoin a commodity? Is it a security? Is, ETH and every single project? And that is a big deal. And I think the SEC in general hasn't harmed crypto. They don't really want to harm it, but they haven't really deemed a lot of things outside of like what look like true utilities to be okay. But that's not the regulatory risk. The regulatory risk is what the SEC is doing enough protection so that no other agency comes in and just says, let's just eradicate the existence of crypto. That doesn't exist today. I mean, I'll give you some examples. Look at what happened with Libra in Congress. I mean, if you were watching the testimony and seeing Facebook under the scrutiny and being, questioned about central bank dominance, you would think that Facebook was making like $1 trillion a year off an $80 trillion global economy. Libra hasn't even launched. Facebook's making zero money from this. On a global economy of 80 trillion and a US economy of 20 trillion, why is Facebook being viewed as a systematic risk on something they haven't even launched yet? That's insanity. And then look at what happened with vaping. Juul and flavored and the sudden rise of deaths, White House bans vaping. That's 120,000 businesses, I believe, in America that were shut down essentially because of it. So if the president can, issue an executive order banning vaping, which was a real economy, regulated, approved businesses, financed by banks.
I see.
You could ban Bitcoin, right?
So you're saying that sword of Damocles is still hanging over our heads. Well, I mean, the way that Binance and BitMEX have tried to address this is by quarantining the American customer from their platforms or launching US-only platforms.
So that's a really interesting thing. I feel like the rest of the world has largely been kind of kept out of financial and technology innovation in the US from investing in it. It's been difficult over the last 20 years. And do you think that's flipping at all? Do you think now the US, citizens in the US will have a tougher time investing in some of the innovation that's happening in our space in maybe the 10 or 20 years going forward?
I mean, in an unpopular opinion I'll share, again, I don't know the future, so, when you ask me about the future and you disagree, I'm pretty much going to say, let's just leave it there because, we don't know the future, so why debate this? But I think an unpopular opinion I would make is, in the next 3 to 5 years, the single most important region for crypto will be America. Because number one, that's where all the millennials are. That's where all the money is, 100 trillion. People, let's think about it. There's $300 trillion of household wealth in the world. 100 trillion is in America. So you just, you land in the US, you got a third of the world's wealth. Mm-hmm. Then you land in China, you got another big chunk. Half of the world's wealth is just in 2 countries. Yeah. Those only 2 countries are going to matter. Really, think about it. But the third is that the infrastructure needed to support a global adoption of crypto is going to be through financial systems. The most important plumbing in the financial system is America. All the biggest exchanges are based in America. I mean, the biggest banks are all America. The most profitable banks are American. So it's all about America.
Okay, so on that point, compare and on the point of these 2 most important countries, compare and contrast the differing kind of responses. I mean, you had Maxine Waters grilling Mark on Wednesday of last week. Nary 2 days later, President Xi came out with his policy speech. How do you explain that?
Man, I'd rather be doing a project in China.
Well, doesn't that contradict what you just said about the next 3 to 5 years? The U.S. being the most...
No, it doesn't, because China's its own economy. The only 2 economies in the world that matter are China and U.S. Let's put it this way. Does Alipay need to be in America to be successful? No. I
guess what I'm trying to say, Tom, is there seems to me a very simple explanation for America's response to Libra, and there is just as simple an explanation for why President Xi would come out with his policy 2 days later. Isn't it that America was the designer and therefore the biggest beneficiary of the existing
reserve currency
as well as its associated payment system, and to some extent the Chinese are chafing under that.
They want to chip away at it any way they can.
Isn't that the Occam's razor here? I mean,
again, I don't necessarily share that opinion, and it doesn't matter. I mean, I would say, look, there's a lot more to it than that, but that's perfectly fine as an explanation.
Maybe shifting gears a little bit, because you're one of the the few analysts in this space that both covers traditional markets and is covering assets in our space as well. So I really want to get an understanding of how do you value something like Bitcoin, right? So you're from a telecommunications background, so Metcalfe's law, network kind of methodologies were the first thing that I stumbled across in Bitcoin to try and put a fair price to it. So, and now people are using kind of scarcity models, like Plan B stuff has been really famous with the stock to flow recently, and I think that's very interesting. So how do we model this? How do you model it? And what do you think of those two valuation methodologies?
Crypto, if it's less than 1% of people in the world own it, and it's going to go to 10 or 20, no valuation model is going to really work. I mean, just think about it. Like, if you were trying to model, any industry over 20 years using a methodology, everything's failed. Because, when you do it, if you're going from 1% to 20%, a 20x, you can't model that. But there are proxies. So, like if you go back to internet, 1997 there were 34 million internet users. Today there's 4.5 billion. And in wireless, there were roughly 34 million cellular users in 1993, and today there's 5 billion. Okay, so both are industries that had the hyper growth that probably crypto will have, because there's 5 billion Visa, MasterCard accounts. So I think over time that's what digital wallets will match in 20 years. Strange thing is if you modeled the FANG price projections, okay, so Facebook, Amazon, Netflix, and you just built your own model, because I saw a lot of analyst models in the 1990s or the 2004s when Facebook went public, they did EPS and their projections. And look at all those models, they were just dead wrong. But do you know that you could explain 75% of the price return of FANG by just Metcalfe law and the number of global internet users? I mean, so the price return of FANG, you could have gotten mostly right by just saying the internet's going to grow.
Yeah.
And so to me, that makes sense. If you're going to value any industry that's going through hyper growth, it's not about supply modeling that matters. Because remember, companies issue stock. Facebook's share count exploded. Google's, they all issue share to employees. If you were doing a supply model, you would have said, oh, it's a short. Look, they're giving 10% of the stock to every employee every year. It doesn't matter. It's really unit demand. So I would say any robust model that's going to survive has to do something that projects the growth.
So if Metcalfe's law applies to Bitcoin and digital currencies, what explains the mostly sideways movement in the market? We've just taken a break, or
well, I mean, wallets have they've stagnated, right? I mean, I think this year Metcalfe's law has explained crypto's stagnation. There hasn't really been an increase in adoption. I think a lot of exchanges would admit activity levels are way down.
Yeah. So, what's the attitude towards digital assets and Bitcoin from the mainstream institutional investors you cover? So we have a lot of talk in this industry about institutional investors, but a lot of times they're kind of like really quasi-institutionals, right? They're not really the big guys. So what's the attitude towards this space from the big guys that you talk to?
Yeah, I mean, it's a fair question. And it's a really important question because, at the end of the day, how do you create a stable price, real counter-cyclical kind of trading dynamic in any asset class? You need institutions, because they are ballast against retail. I mean,
the yin and the yang of the whole thing, right?
Yeah, you can't have one or the other.
Yeah.
But institutions, they have two canon or two frameworks that they need. One is they need to believe something has a lot of price appreciation potential. Like, no institution's going to buy an asset class that they think goes down, right? So Bitcoin, from that perspective, has not proven it's even an asset class that can go up. Bitcoin made an all-time high in 20,000. It got to 14,000 this year, but I think until Bitcoin gets back to 20,000, you're going to see all these people do the same charts. NASDAQ, South Sea Bubble, Echo Bubble. I mean, all these same charts that, we roll our eyes, but at the end of the day, someone's got a point. Bitcoin has to make a new high. But the second piece of that is institutions have to then have an understanding of how the price can go up. Like, there has to be a logical framework that they understand. And today, as you know, there's no model that explains Bitcoin, so they don't know how to value Bitcoin. And then, of course, I think Bitcoin today doesn't even matter statistically. I mean, it's a $200 billion market. stocks are 66 trillion. If they matched equal weight, if they did a market weight on Bitcoin, it's a 0.1% allocation. It'd be nothing.
Yeah. And then the liquidity is so fragmented too. Like it looks on a single day like you're getting decent liquidity, but it's fragmented across probably hundreds of exchanges. So to put a significant amount of money to work, any amount of money that they would consider a minimum investment, it's quite difficult to get that in, isn't it? And to get it out.
Yeah, I mean that's chicken and egg, right? It's kind of a chicken and egg.
So, but it seems like there's more infrastructure being built that can support that. So I think you still have to be probably cautiously positive that comes when you have things like, Fidelity and Bakkt, and we see the volumes picking up in Bakkt. And Fidelity kind of solves the custody issue, which I think is a big problem for institutional participation. Because nobody wants to have their broker, their exchange, and their custodian all like on a single entity, right? That's not really how traditional markets work. So to have it split out with a custodian that they already know and have already onboarded, that makes it a lot easier and doable.
Yeah. If you ask me, okay, what are the impediments to Bitcoin? And someone said, you pick liquidity, price, or framework. I would say liquidity will be the least important to an institution. Because let's say Bitcoin was liquid trades like water and it was still at 8,000. Yeah. No institution is going to get involved. Yeah. Like Bitcoin has to prove it's an asset that you can make money. I mean, to me, price is the single biggest impediment to institutional adoption. I think people are overthinking it. Like, there's plenty of liquidity in crypto. People just aren't trading because they don't think it actually, it could get banned. I mean, who wants to have $1 billion position in Bitcoin that gets banned by the White House? It's the more common sense fact is that an institution is like anyone buying a stock. They want it to go up.
Yeah. So
okay. All right. Maybe it's getting time to wrap up, but you clearly don't subscribe to Ray Dalio's debt cycle, so I won't ask you about that. But I mean, how about just the roughly 10-year cycle, the cadence at which some freeze up in the market or something or other of significance happens? Are we going to close this decade out with nothing major?
A financial crisis?
Yeah.
Well, there's a financial crisis. There's always a financial crisis somewhere. I mean, just think. Even since 2008, there have been multiple financial crises. We had the peripheral crisis. Now we have Brexit and Grexit, and we have a repo market problem today. But I think what everyone has a tendency to do is they carry a 2008 hammer and think every crisis means it has to play out like 2008.
So it's burned in everyone's brain. It was so painful.
Yeah, and just like in 2000. When the internet bubble burst, everyone said internet was bad, right? Guess where all the money was made between 2000 and 2008? The best performing assets, whether venture, private, or public equities. It was in the internet carnage. That's how the FANG emerged from the internet bubble. So, people have to shake their bias, and everyone thinks there's a financial crisis. And there's gonna be, but does it mean you need to position your portfolio that way? I mean, I'll just say 2019 is a perfect example. It's the single best year for risk markets in more than 25 years. So in other words, for most people's if you're a professional investor, in your lifetime, you've never seen a market this good. Mm-hmm. Most people sat out that market. How do you explain to your investors that you voluntarily sat out the biggest market in history, even though all signs pointed to this being 2009 again, like a monster year?
That's what clearly the numbers say, Tom. It's just in the rough 25 years that I've been an adult, I'm going on nothing more than my intuition, but it seems to me that the fires burning in Chile and Hong Kong, what may or may not happen with Brexit, and then what's going on in the States, right? Yes, impeachment, we've gone through this before, even my adult lifetime, but it was not, it was some affair in the White House. It was not, trying to involve foreign powers. The question here that I think we'll end on is, do you think we're in a new regime where things are different fundamentally than 20 years ago, or is it just...
I think the problem is, if you've only done something for 25 years, you just think everyone will naturally think things are worse. I mean, no one really goes through life and says the world is getting its act together, right? Everyone always thinks the world's... So I would say if someone had 75 years in this business and then they talked about the last 25 years, I would listen I've done this for 27 years. I study cycles. I don't have that much confidence in my personal experience and knowledge of markets. But I also know that things were worse in the last 90 years. So I think one of the things is everyone uses their own recency bias or personal experience to project what they think markets should do. That would just be my point.
Fair enough.
Yeah.
Thanks so much, Tom.
Great.